And this is another example to teach you guys why markets always float and they don't fall, is because even when there's more people shorting than longing on the non-dealer side, the market still goes up. It doesn't matter the degree of shorting. This is where most of the gurus get this thing wrong. It's crazy how people think. I always see people, oh, put flow, tons of puts, market's bearish, high put to call ratio. I'm just like, oh yeah, that's like, can you stop? Stop talking. Shh. Quiet. The adults talk. People are stupid, I swear. And it's crazy. But it doesn't matter how short the market's going. If there's like literally one person buying, the market will stay up. It's crazy how Wall Street's designed to do that. As long as there's a willing buyer, that's it. This stuff floats. It doesn't matter how many people or how aggressively people are shorting the market. Here's an example on the short side of this. November 2023, from here all the way until April of 2024, aggressive shorting, and the market was flat. No new buyers, slight amount of new buyers, and we just went straight up. It's the crazy part of how this shows you that it doesn't matter how many people are shorting the market. As long as there's willing buyers and the buyers aren't selling their stuff to cash, markets float. They go up. They continue to go up. It's always been that way. It's such an interesting phenomenon. Betting against the market with an active bet is different than selling the market. They're both sellers, right? But one of them is selling to engage in a trade. The other one's selling to get out of the way and go to cash. One of them is selling, adding liquidity to the market. One of them is selling, getting liquidity out of the market. So selling and going to cash is removing yourself as a trader, and then you're adding to the illiquidity, to the volatility, right? So just because there's a massive amount of people continuing to short further and short further and short further, they're mostly just doing that to hedge the bull side. And that's usually what you see when you see heavy-handed shorts. You know, with the majority of people understanding the market just goes up over time, the majority of Wall Street is going to be betting long most of the time. The majority of the quote-unquote put flow you see, or the options flow you see, or the high put to call ratio is mostly people hedging with insurance. There's almost never a time in history where there's more people selling or shorting the stock market than longing, with the exception of a market crash. And that's usually what causes the crash, when the market finally tilts over and there's people dumping shares faster than they're buying shares. And that's pretty normal. My put to call ratio is like really high. I'm like, well, doesn't that make sense? Because there's twice as many longs as shorts. There's gonna be twice as many puts than calls to hedge. I'm long in the market with puts underneath me to hedge. I'm extremely bullish. And I bought puts. I didn't buy any calls. Buying calls because you're bullish. What are you, some day trader in a Discord? You're the only person doing that, my man. I mean, hedge funds are sitting there, I'm gonna speculate and buy some 0-day calls today on Amazon. People don't do that. You're doing that with your money. They're buying stock with it.